Hello, welcome to Kenanga Research. My name is Sarah Lim. Today we will be highlighting our take on the recent corporate reporting season. The recent reporting season was much weaker than expected, despite a few rounds of earnings downgrades earlier. Out of 135 stocks under our coverage, 40% of companies' earnings disappointed versus 34% 3 quarters ago. 49% of companies met expectations, while only 11% of companies beat expectations. Earnings forecasts were cut by 3.6% to 4% for this and next year's earnings. Key affected sectors were the transportation and logistics, retail-based consumers, plantation, oil and gas, gloves, and aviation. They saw significant downgrades in the current year earnings of more than 5%. The only exception to the earnings downgrade was the semiconductor segment. The semiconductor players like Unisem enjoyed higher utilization rates, lower cost of sales, weaker ringgit, and the underlying upcycle in the tech industry. The trend is likely to continue until the next quarter. The oil and gas sector fell victim to lower oil prices after a fairly long rally of close to 3 years. The sector experienced double whammy impacts in terms of target prices revisions, as target prices were cut by 20% on lower earnings and PE multiples. There are uncertainties over contract flows, Petronas capex implementations, and charter rates. Petronas revealed that they are looking at a 15% to 20% cut in its 60 billion capex for new projects next year. In line with OPEC's decision to keep production targets unchanged, Petronas is looking at an oil range target of $70 to $75 per barrel for 2015. The plantation sector was not spared as well from the commodity sell-down. So far, our plantation analyst has lowered his 2014 CPO price assumptions by 4% to 2,400 ringgit per tonne. He indicates that 2015 price assumptions may be trimmed further by 6% to 2,350 per tonne. So investors should anticipate more earnings downgrades in 2015 from the plantation sector. The glove segment also reported weak results, although it was driven by company-specific issues and is likely a one-quarter hiccup. Growth will resume in coming quarters on the back of new capacity expansions. In the aviation space, we had upgraded AirAsia to outperform with a higher target price of 2 ringgit and 80 cents. The stock will likely benefit from lower fuel costs. Retail-based consumer stocks were much weaker than anticipated, although we had taken a conservative stance on your estimates in earlier quarters. Weaker demand and higher cost pressures have been unfolding ahead of GST implementation as the nation is undergoing higher living cost environments due to subsidy cuts. Our strategist has toned down his 2014 FBM KLCI target by 2.1% to 1870, while 2015 targets are lowered by 1.5% to 1950. Market sentiment has turned weaker. So we recommend that investors adopt a buy on weakness strategy. Key support or lowering buying zones or 1775 or 1760 are recommended. I am Sarah Lim. That is all we have for this segment. Till next time, have a good day.